Hello and welcome to Wall Street Vision, a show that explores investment ideas from the best investors in history. I'm your host, Vlad. This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. I may maintain positions in the securities discussed on this podcast. Hi everybody, thanks for joining us for this week's episode. This episode is going to be about leverage. We'll cover leverage in more detail later in the episode, but basically leverage is just borrowing money to increase your returns. We're going to discuss leverage from an investing perspective as well as leverage in your daily life and how you can use it to your advantage. But first, I want to start with a story. I'm not sure if you've heard of this one before, but it's simply fascinating. So long-term capital management, or LTCM, was this hedge fund that was started in 1994. LTCM was started by John Meriwether, who was the former VP and head of bond trading for Salomon Brothers. Salomon Brothers was this really big name investment bank back in the day. John Meriwether was a huge figure on Wall Street. When he was choosing the team for his hedge fund, he got the best and brightest people. Their board of directors included two guys who got the Nobel Memorial Prize in economics. The rest of the partners list was also really impressive. You had PhDs from MIT and other top-notch finance people as well. Funny little anecdote, when John Meriwether had started up LTCM, he spoke to Warren Buffett and Charlie Munger. But neither of them wanted to invest in the fund because they thought that the leverage used would be really risky. Back to our story. If you read up on the individual strategies that LTCM used, they get pretty complicated quickly. But in a nutshell, LTCM would buy undervalued assets and wait for their price to rise to fair value, or they would short sell overvalued assets until the price on them decreased and LTCM made a profit. This included bonds, stocks, and currencies. Essentially, LTCM picked really low-risk strategies that worked most of the time. Now, these strategies would give small returns, so to juice up the returns, LTCM borrowed a ton of money. The strategy at LTCM probably felt like free money, but it was more like picking up nickels in front of a steamroller. From an investing perspective, leverage means borrowing money to amplify your returns. So if I only have $100 to invest and I'm getting a return of 5%, I can get $5 after I invest my $100. If I borrow $900 additional dollars and now I have $1,000 total and I invest it, now instead of earning $5, I'll earn $50 of a return. So the leverage amplified my gains. That's essentially what LTCM did. They borrowed money to increase their returns. Now, leverage can amplify gains, but it can also amplify losses, and we'll get to that soon. Apparently, the model used by LTCM to calculate risk for all of these trading strategies was based only on historical data. That means that it failed to predict possible low-chance outcomes that had not happened yet historically, but that might happen sometime in the future. The firm had a ton of loans on their books. Their debt-to-equity ratio was over 25-1. To put that into perspective, imagine if you paid off the mortgage on your house, then you borrowed enough money to buy 25 other houses. That's a lot of leverage. Up to that point, LTCM had done really well. They had returns of 40% for their first 2 years in business and 27% in their third year, and that's where things started to change. It all started to turn sour around 1997, where there were these lingering effects of the Asian crisis that started to spread outside of Asia. In 98, LTCM had some negative returns, being down over 6% in May and 10% in June. This caused LTCM's capital to go down, but you have to remember that since they had a ton of debt, this actually increased their leverage. Essentially, their loan size remained the same, but the stocks they owned went down in value. Those negative returns increased LTCM's leverage, and with more leverage comes more risk. That's the bad thing about leverage. If you're using it in investing, as your stocks lose value, you're automatically getting more levered on a percentage basis. So you're in a riskier position as your stocks lose value. It can be the beginning of a vicious cycle. So LTCM had these negative returns that are starting to scare the partners at the firm. I'm sure there's rumblings at the water cooler at the office about how things are not looking that great. On top of this, you also have the 1998 Russian financial crisis, where the Russian government defaulted on their domestic local currency bonds. This was something unexpected, because at the time, everyone thought that a government that can print their own currency would never default on their debt. It caught people off guard, and it caused a bit of a panic as investors sold off riskier investments and bought safe investments instead. This really put the last nail in the coffin for LTCM because cheap, risky securities became cheaper, and expensive, safe securities became more expensive. Essentially, the market moved against their positions. By the end of August, the fund had lost around $2 billion. I'm sure the mood at the LTCM offices was somber at this point. You had a group of the smartest people on Wall Street, and suddenly they were losing tons of money. That would have been hard to take financially, but I'm sure it also hurt the ego as well. They were at a point where they had to try and raise more money to pay their creditors. LTCM didn't have that many options left on the table, so they ended up getting a bailout from the same companies that gave them the loans in the first place. It was a big mess, but the creditors who loaned money to LTCM didn't want the firm to go bankrupt because they might not get paid back if that were to happen. So they were essentially forced to participate in this bailout. With that bailout, LTCM was able to stay in business and to operate until it was liquidated in early 2000. When I'm thinking of this story, it reminds me of the US Olympic basketball team in 2004. They had all-star players like Dwayne Wade, Tim Duncan, Allen Iverson, and so on. And then, in the end, Argentina beat them. LTCM had the brightest PhDs and best finance people, and they still ended up getting crushed. That's the power of leverage. It can give you great gains, but it can also give you great losses. When most people talk about leverage, they're talking about how much companies borrow. In the LTCM example, they borrowed a ton of money to amplify their returns. When you hear of a highly levered business, it means the business has a ton of debt on their books. But not all leverage is bad. I'll give you a quick example. Let's say you own a gas station. The gas station is located downtown and there's no gas stations in the area, so people use your gas station for convenience. You have enough space to put in 2 more fuel pumps to help service more customers. You go to the bank and borrow $100,000 to put in the 2 pumps. Your business just became more levered. You borrowed money, but hopefully the 2 new pumps will increase revenue and pay off the loan. So leverage is not always bad. In this case, if you know for sure that the extra supply will be met with the current demand at the gas station, you'll be okay, and the leverage will allow you to make more money. Warren Buffett doesn't really like using leverage in his investments. He sees leverage as an asymmetric risk. From Warren Buffett's perspective, when you're using leverage in investing, the downside is huge and the upside is small, so he doesn't like to borrow money to invest in stocks. But looking at Warren Buffett's history, he did use a form of leverage in a different way. When he had the Buffett partnership, he would take on a bunch of investors, gather up their money, and invest it for them. Instead of borrowing money, he still had a large amount of capital to work with. And he made a fee on the money that he managed. So essentially, Warren Buffett got to benefit from the upside of leverage, and since he didn't borrow the money, he didn't have to deal with the downside of leverage. Smart man. The biggest risk of leverage for an investor comes from buying a stock with borrowed money and using the stock as collateral. That's what happened to LTCM, but I want to put it into a more of a personal example. Let's say you take $3,000 of your own money, borrow $7,000 and buy $10,000 worth of stocks. You use the shares as collateral. If your broker requires a minimum 70% loan-to-value ratio, if the shares fall below the $10,000 in value, you'll get margin called. So you'll have to pay the broker to maintain the 70% loan-to-value ratio. If you don't pay the broker, they'll simply sell the shares to cover their loan. That's pretty much what happened in LTCM's case. As we've discussed, Warren Buffett is not a fan of using financial leverage like borrowing on margin to invest. That kind of leverage can wipe you out, and the world is a highly unpredictable place today. So events that seem like they only have a 1% chance of happening might actually happen. The price of oil went negative last year, and we're in a global pandemic right now, so unlikely stuff happens all the time. Warren Buffett talks about how he has 2 rules in investing. Rule number 1 is never lose money, and rule number 2 is never forget the first rule. Leverage creates an environment where if you have too much leverage, you can lose all your money, so it's a really high-risk strategy. In this episode, I also want to go over this relatively new type of leverage that involves products with no marginal cost of replication. So these are things like books, media, movies, code, patents. As an example, Satoshi Nakamoto is the first person to write the code for Bitcoin. Satoshi produced code that has led to over $1 trillion worth of wealth, and that's the market cap of all Bitcoins in circulation today. It's amazing that it was just one person that was the catalyst for all of that wealth creation. A patent for a technology that a company can license for a royalty is also leverage, because once the licensing deal is done, the company that owns the patent is just collecting checks in the mail. A YouTuber can create a video, and the amount of work that it takes to produce is the same whether one other person sees it, or 1,000 people see it, or 10,000 people see the video. So each additional view doesn't cost anything to the content creator. The economics of this are great for the company or the person making the product. It allows for amazing margins because you have minimal costs for each additional unit produced. These types of products essentially create unlimited leverage. Let's talk about a few other forms of leverage that you can use in your daily life. Software is a form of leverage. I use email every day, and taking a course on how to optimize Outlook has helped me increase my productivity by a lot. Squeezing more juice from the software that you use every day is really powerful. So learning to use software that you're already using every day and learning shortcuts like Ctrl-C and Ctrl-V to copy and paste can save you a ton of time. Labor is another form of leverage, and delegating can help you tap into its power. Delegating or asking other people to help can be very powerful. If it takes you 15 minutes to do a task together with the help of somebody else, but it would take you an hour and a half to do it on your own, it really makes sense to ask for help. I also want to mention that not all leverage is bad. A mortgage is a form of leverage as well. The only difference between a mortgage and a margin loan, for example, is that if your mortgage goes underwater and you owe $500,000 to the bank, but your house is now only worth $450,000, you're not going to get a margin call that can bankrupt you. If your mortgage goes underwater, you can simply keep making your monthly payments until you pay it all off. You won't get kicked out of your house. So the riskier forms of leverage are the ones where someone can ask for their money back at any time. That wraps it up for this week. My big takeaway is that leverage makes your gains bigger, but it also makes your losses bigger. I have an analyst friend that said it best when he said, "Leverage is like salt. If you sprinkle a little bit, it can make the meal taste better, but if you put too much, you'll ruin the whole meal." Thanks so much for listening, and I hope you have a great day.